Look at the screen, one of these wines is lying to you. While the S&P 500 celebrates record highs, the lifeblood of the global economy, crude oil, just collapsed 20% in a single quarter. It's trading at $56, so this isn't a correction, this is a siren. But here is the mystery: if the economy is slowing down enough to crash oil, why is silver exploding to $80? The stock market thinks this is a Goldilocks soft landing. The bond market knows it's a deflationary shock. Today we break down why the real economy is grinding to a halt and why the metals market is screaming that a massive liquidity injection is coming. Let's look at the plumbing. The mainstream media cheered when the Federal Reserve announced in December that they were halting quantitative tightening and starting $40 billion in monthly T-bill purchases. They call it reserve management, we call it silent QE. But here is the math problem. The deflationary hole blowing open in the global economy is in the trillions, not billions. That 40 billion is a band-aid on a bullet wound. The bond market knows that stopping QT isn't enough. To stop oil from hitting $40 and taking the high-yield credit market with it, the Fed doesn't need to sip. They need to flood the zone. This is why yields are falling. The market is front-running the real QE that must follow this silent pilot program. But there is a second, darker reason silver is diverging from oil. While the West fights deflation, the East is securing resources. Beijing sees the same deflationary writing on the wall. They know that when the Fed inevitably pivots to a massive QE to save the US bond market, the dollar will debase. So, what are they doing? They're hoarding real assets. New data confirms that starting next week, China is activating active export controls on silver. They're effectively taking 20% of the global refined supply offline. They aren't selling their silver for the value of dollars anymore. This turns a monetary hedge into a physical shortage. And it gets worse. Look at Japan. The 10-year yield in Tokyo just broke above 2%. Why does this matter to you? Because Japanese pension funds are the biggest foreign owners of US debt. With yields rising at home, they're bringing their trillions back to Tokyo. They're dumping US treasuries, and this leaves Uncle Sam with a massive problem. The US national debt just hit $38 trillion. The interest payment on that debt have now surpassed the entire defense budget. Now, the Treasury General account stands at $833 billion. That sounds like a safety net, right? But don't be fooled. It isn't a war chest for stimulus. It is already spent. That cash buffer is the only thing standing between the Treasury and a failed auction. It is being drained rapidly just to pay the interest on the debt. Once that $800 billion is gone, the Treasury has to issue trillions in new debt into a market where China and Japan are sellers. Who is left to buy the bonds? There is only one buyer left: the Federal Reserve. They have to print. That is why the bond market is not scared of inflation. It is terrified of solvency. Now, the optimists will tell you cheap oil is great, it is a tax cut for the consumer. You see airline stocks rallying because their fuel costs dropped, but history proves that logic is dead wrong. During a shock like in 2008, oil didn't crash because we found more of it. It crashed because global demand had a heart attack. Low prices are only good if you have a job to enjoy them. When oil collapses this fast, it's not a tax cut, it's a signal that the global trade is freezing. Here is the verdict: the cure for low prices is low prices. At $56, US shale drilling stops, supply vanishes, meanwhile China locks the gates on silver. We are entering a volatile window. The Fed's $40 billion silent QE is just the appetizer. The main course, massive liquidity, is coming when something major breaks. Now let's look at the elephant in the room: the S&P 500. You're watching oil crash and silver spike, yet your stock portfolio is hitting all-time highs. It feels like insanity, but it isn't. It is mechanics. The stock market is not the economy. The stock market is a liquidity gauge. Right now, algorithms are programmed with one simple rule: bad news is good news. When oil crashes to $56, the computers don't see a recession, they see a Fed panic, they see rate cuts, and they see the money printer warming up. The worse the data gets, the higher stocks go. This is the melt-up. We likely have more room to run and the upside in the short term because capital is leaving Europe and piling into US tech stocks as the safest place to hide. But make no mistake, this is the trap. Look at 2000, look at 2008, look at 2019. The biggest rallies often happen right before the rug pull. We are in the blow-off-top phase. The market is pricing in the Fed's rescue, but it is ignoring the damage already done to corporate earnings. When does the crash come? It comes when the bad news stops being a signal for stimulus and starts becoming a reality of bankruptcies. When the high-yield spread blow out, the algorithms will flip instantly. They will go from buy the dip to sell everything. So enjoy the rally, but keep your finger on the exit button, because the higher we go now, the harder we fall later. The algorithm wants to feed you the consensus soft landing narrative which track the data they ignore. If you want to be on the right side of the trade when the liquidity floodgates open, hit that subscribe button and turn on notifications. I'm Georgie, keep your head on the swivel.